The S&P 500 rose 0.78% to 7,498 points. The market was once again boosted by gains in technology companies. 6 of the 7 companies known as the Magnificent Seven rose today, with the exception of Amazon, which fell only 0.67%. Semiconductor companies also saw significant gains, with AMD rising 7% and Intel and ASML also climbing more than 5%. Significant investments in the artificial intelligence sector continue to drive increased profits for semiconductor and memory companies, as seen in recent results such as those from Micron. Additionally, the U.S. Consumer Confidence Index came in at 91.2 points, 0.6 of a point above estimates, a figure that also helped the market. 7 market news and facts today. The first concerns a tremendous increase in investment-grade corporate debt, which is expected to rise by 25% this year, reaching a record $2.25 trillion, marking 4 consecutive years of growth. The driving force behind this debt increase is capital expenditure, CAPEX, on artificial intelligence, which, according to Morgan Stanley, will reach approximately $400 billion. The development of the AI revolution is leading to a historic increase in corporate debt. Recall that yesterday we published a report from the Bank for International Settlements, BIS, which indicates that increased credit may carry significant risks. The market is pricing in a rapid adoption of this technology, which could lead to disappointing returns and the consequences of sudden withdrawal of funding from the artificial intelligence sector, potentially turning the current spending boom into an investment crisis in the future. The second piece of data concerns the returns achieved by some stock markets this quarter. Thanks in large part to semiconductor company stocks, the United States, South Korea, and Taiwan have seen excellent returns. In Latin America, Colombia has also performed well due to the so-called election trade. In Europe, Greece, Italy, and Spain stand out. Among the worst performers this quarter are Brazil, due in part to election uncertainty, and China, which continues to struggle, partly due to the real estate crisis that has persisted for several years. The third piece of data is the consumption of artificial intelligence tokens for the last month, which shows a 195% increase for Chinese companies and a 69% increase for North American companies. This could pose a risk to the semiconductor sector, as Chinese companies may be able to offer similar artificial intelligence services to those of North American companies at much lower costs, potentially leading to unmet profit expectations for North American companies. The fourth data point is a list of S&P 500 companies related to artificial intelligence, which now includes 41 companies, encompassing semiconductor companies and hyperscalers like Google, Amazon, and Microsoft. These companies currently represent 44% of the North American market capitalization, but reached a peak of 49% at the beginning of the month. This situation has led to the market becoming overly concentrated on a single theme, unlike anything seen in the last 150 years. The last time was during the expansion of railroads in the 19th century. The fifth data point concerns the expected growth of S&P 500 EPS, earnings per share, for the second quarter of this year, which stands at 22%, with the energy and technology sectors contributing the majority of this growth. It is interesting to note that in the first quarter, earnings growth was 27%, exceeding the expected 12%, which has partly contributed to the recent rally in the American stock market. But the key point here is whether this will be sustainable in the coming quarters due to the increased sales of semiconductor companies driven by the rise of artificial intelligence. The sixth piece of data is this graph showing how the rise of artificial intelligence has come in stages. The first wave fueled the growth of semiconductor companies like NVIDIA. The second was related to energy and data center development companies, and the latest wave has been driven by memory companies. The seventh piece of data concerns the outflows from Bitcoin ETFs, including the well-known IBIT. These ETFs have already accumulated net outflows of $4.5 billion in the first quarter and $1.35 billion in recent weeks, which has led to declines in the cryptocurrency's value. According to analysts, a significant portion of these funds have gone towards rapidly appreciating assets, such as semiconductor and memory companies. And the last piece of data for the day is this chart showing how the U.S. dollar has gained 7% in the last 5 months, while gold has fallen 26% and silver has dropped 50%, contrary to what many traders expected at the beginning of the year. This demonstrates that narratives can change rapidly and assets don't appreciate indefinitely. Oil prices fell today after tensions between the United States and Iran eased, and reports show a notable increase in oil tanker traffic through the Strait of Hormuz in recent days. Furthermore, information has emerged indicating that Asian refineries are even rejecting oil that had managed to pass through the Strait of Hormuz. These shipments have had to find routes to the United States, even crossing the ocean, which would demonstrate that the market quickly went from a crude oil shortage to a potential oversupply, dragging prices down. Countries like the United Arab Emirates, Kuwait, Qatar, and Iraq are increasing their production levels to pre-war levels and are seeking to quickly place large volumes of crude oil on the market to try to compensate for the losses incurred during the more than 100 days of the war, during which these countries were unable to sell their usual crude oil volumes. Gold fell slightly by 0.42%, while silver rose by 0.7%. In the case of gold, the recent declines are already the worst in a single quarter since 2013. Expectations of higher inflation and 1 or 2 interest rate hikes by the Fed this year remain quite high. Recent year-on-year inflation data of 4.2% in the United States has increased the likelihood of interest rate hikes by the Fed this year to over 80% by September. This has led to an outflow of investment flows into gold and silver in recent days. If interest rates rise, some investors might seek alternatives like U.S. Treasury bonds instead of assets such as gold and silver. The stabilization of crude oil prices could help ease inflationary pressures and gradually lower the market's expectations of rate hikes this year, contributing to a rebound in metals like gold and silver. Remember that in the video description, you'll find a link to the best course for learning how to invest in stocks, ETFs, and the stock market, as well as one of the best platforms for stock trading, which is regulated and accessible from various countries. If you enjoyed the video, please give a like and leave a comment and share on social media.